can fintechs still be disruptive in this environment? Can they justify their premium valuations when investors are demanding discipline?
Yeah, and thanks for having us. Look, when we think about the actual innovations that are going on and the ability for these companies to grow at a rate that's notably faster than especially banks, we do think it's actually sustainable and differentiated. We recognize that right now, there's obviously a lot of uncertainty in consumer spending, which has a direct impact on most fintech names, especially the payments names. But you can't forget about the fact that we now have 400 million users of PayPal globally, which is bigger than most banks have accounts. And you think about it as a two-sided network. There's loyalty there. Same with Block and Cash App and what they've built out. So listen, I tend to agree with what you guys were saying earlier around some of the smaller ones needing cash, may burn cash, but some of the larger fintechs, in my view, are going to, really should maintain a very good premium to banks and other names in the market, given their consistent and sustainable growth.
Right, those user growth, those user numbers, 400 million at PayPal, is really, what investors have been excited about. But has there been a failure to monetize? Look at what PayPal has and has not been able to do with Venmo.
Yeah, no, look, it's a fair point. I mean, at the end of the day, the checkout experience is something they really do need to improve on. And that's something that, we have a peer perform, a neutral rating on the stock. And that's really coming from two things. One is we do have a little bit of concern over the recession sensitivity to the name in a downturn. It's very much discretionary spending. So keep that in mind for PayPal. But on the same token, we're still trying to figure out if they're holding their market share on the core PayPal or on Venmo relative to what we saw during the pandemic of very strong growth. Now, with all that said, they are improving their checkout experience. They have partnerships with Apple now. They have partnerships allowing for checkout to not enter a password, which I know we all hate to do. It's much more seamless. So they're going in the right direction, but they have to prove themselves.
Darrin, let's talk about Bill.com, which doesn't always get talked about as a fintech, but should. Beat and a raise, but acquiring Finmark. You wouldn't know that necessarily from how the stock is doing this morning, down almost 7.5%. But projecting stability there, growth 94% year over year. What do you see happening here?
Yeah, I mean, talk about growth, perhaps being underappreciated. I think the real concern that's happening is when, despite the beat, despite the raise, management on the call talked very similarly to what we're hearing with a lot of companies about macro trends changing and potential for a slowdown in business spending. And not to mention, they also alluded to maybe the take rate might expand more slowly, just given the same dynamics on macro. This is a company that's trading at a relatively high multiple. It's a software-centric name. And I think there are still very high sensitivities to anybody in the market that has a high multiple, not being crystal clear, perfect in every way. As much as our view is, and we like this stock quite a bit, as much as our view is they're going to have sustainable upside and a lot of levers to make numbers work, in the backdrop of this macro heightened market, sensitive market, it's really what's pushing it down.
Darrin, what do you think the conversation sounds like at Legacy Financials, who a year and a half ago might have been feeling nervous about the competitive threat from disruptive fintech? I mean, is it we're going to wait till valuations get cheap enough to buy some of these players, or maybe now it's a more clear shot to build something organically? How does it sound?
That's a great question. I mean, number one, don't forget that banks and any consumer finance company, they have their own challenges from a macro standpoint to worry about as well, specifically credit quality and whether that's going to change given we're still very low unemployment, even with rising rates. Now, with all that being said, I think they've spent, and if you ask any bank CEO, are you going to keep spending on tech? They're absolutely going to put that on the top of their list of what they're going to keep doing to innovate. For what it's worth, about 25 to 30% of total banking app downloads right now are on neobanks. Okay, and by the way, if you included Square or Block and PayPal and Venmo, that would be almost 50%. So think about what I just told you. Of all the largest banks, consumers are still downloading these fintechs to use on their mobile. So they have no choice but to either invest more in this fintech area, or potentially what you said. I think wait for some lower valuations and buy.
Yeah, that's certainly what we heard from SoFi CEO Anthony Noto earlier this week. He said he was pulling customers over from the big banks specifically. Darrin, thanks for being with us this morning. Wolfe's Darrin Peller.